I know we're talking about real estate, but I also works into other aspects of life. Is you overlook all the red flags in order to make that work. So it's the same thing in this case.
Hey everyone, welcome back to the Real Estate 101 podcast. As always, I am your host, Robert Leonard, and with me today, I welcome back a pretty cool guest, Sterling White. Welcome back.
Yes, appreciate it. Everyone who's on here, go ahead and strap in your seatbelts. Hopefully that you already have your seatbelts if you are driving, because we're going to take you along for a ride.
It's pretty cool to have you back on the show because I like all of my repeat guests, but it's really cool for you because you were just the third guest to ever join me on the show when I started hosting a podcast. And you can go back, if anybody's listening, go back to listen to episode number 3. I was a horrible host. I didn't know how to talk into a mic. Sterling was great as always. So listen to his stuff. Don't listen to me too much, but it's cool to have you back after over 2.5 years. Give us an update. What have you been up to in that time?
Man, time has flown from the 2.5 years. I mean, just in 2020, that was what, 5, 6, 7 years, it seems like. And some people say post and pre COVID, sort of like the BC and AD, I think is how you say it. But is I would say a lot from a what do you call that, mindset shift in the way in how I view the world, but is also I moved from Indianapolis to Houston. So that was a significant move that I've made. And I would say love, enjoy being out here. The only thing I would say, Robert, is they say everything's bigger here in Texas except the toilet that I have. So I don't know if I just have a defective toilet because it's the same size as the ones back home.
What made you make the move from Indy to Houston?
I'd say is real estate was a part of that decision. Also, the weather too is during the winter times, it is brutal in the Midwest in Indianapolis. So there's that. And then also, I just wanted to change. I was having success in Indianapolis. I started to get a little bit more comfortable. And as a way to really just change up the environment, I just ended up moving to Houston. And I'll tell you, I was scared, not scared. Yeah, I would use the word scared or just fearful in making that such of a big decision. And as soon as I was thinking about making the move, is all these different thoughts came in my mind. You've been living here all your life. Your family's here. That's the unknown. And when I've had my biggest breakthroughs in life is when I've actually leaned into it.
There are a lot of places you could have gone. Why did you choose Houston?
Yeah, so I was looking at Tampa and then I was looking at Austin. So one, the cost of living here is good on that side, and then also buying deals as well as you really get the best of both worlds from an appreciation and a cash flow, and it's diverse from the people that are here, the culture. So there were just a multitude of things, but more so from a real estate play, and then also from a cost of living, because I ended up Tampa was one, and then I ended up narrowing down to Austin and then Houston, and then Austin. The getting cash flow and yields out there a little bit more difficult, and then also the cost of living is higher too. So that's when just Houston made the most sense.
For those who didn't hear our last episode together, since we've gotten a lot of new listeners since then, tell us a bit about your background and your upbringing through Section 8 housing and how that's led to where you are today.
Yeah, so humble beginnings for myself is that grew up in the not so good parts of the city of Indianapolis, where when you're driving through the neighborhood, you'd lock your doors and roll up the windows. Single mother, fraternal twin brother. Some people say he's as dark as Wesley Snipes. I don't think he's that dark, but is and at the age of 5 years old, almost lost my life due to a stray bullet. And that was just another day and living in the hood, and you never knew if you was going to make it to the next day. And then luckily ended up making out of that environment when mother moved us out from the inner city to more of the suburban location. We were still lower income housing. My brother went back to that environment and actually took a different trajectory in life and got started in real estate on the construction side as a laborer. And then I read the book Rich Dad Poor Dad. Everyone's familiar with that book. And well, most I would say. And I saw that the rich and wealthy people did not get that way by being laborers, and I started investing figure out a way to become an investor. So, but I had no cash, and credit score wouldn't even register when you would pull it. So ended up finding someone to partner with who brought the cash on that very first deal, which was a single family house, bought 150 single families, and then started transitioning to multifamily, which got up to about 500 units, and over the years have been selling.
How did you make that transition from the smaller deals, the single family deals to multifamily? And why did you decide to make that transition?
All right. So is I've got a hat on for everyone who's on here, and but is part of the reason due to that is having that many single families, 150, is I lost a lot of hair due to that because there is I was self managing, and when I say I, there was a team involved as well. Is that there's a lot of moving parts. This wasn't just one package of 150 single families that would have been nice, but this was a lot of one offs, and if lucky, we'll get a package of 2 to 3 here and there. So it was a lot of volume, Robert, with looking at a lot of deals in order to get one. And then also from the management standpoint is had 10, 11 employees or so, roughly around that, in order to manage all that, because had several in Indianapolis and then several in Dayton. And then took a step back and said, which model is more scalable? And it just made the most sense to make that transition to multifamily. And this was in 2017.
Since you lived in Indy, you spent a lot of time focusing on that market. I'd say you know it really, really well. How has that market evolved over time for real estate investing? And where are you focusing your efforts now outside of just Indy? I know you mentioned Houston, but are you looking in any other markets as well?
Yeah, so I actually bought a deal. This was an 80 unit in Louisville. This was 2019. Yeah, 2019. And so primarily in the Midwest market. So Louisville, Louisville, or Louisville, however you want to pronounce that. And then also Lexington, Kansas City, and then several markets such as Cincinnati and Columbus in Ohio. And how Indianapolis has shifted over the years is it's becoming even more competitive, and the price per unit, that's one gauger I would always use when buying deals, is could be all into a property anywhere between about 50 to 55 thousand per unit. And this is in Indianapolis, you guys. People in California are thinking, I couldn't even, what? There's no way. So be all into the unit about 50 to 55 thousand, and then be able to rent that and push the rent up to about $800 on average. However, that has gone up to 70, 75 per unit. So just in essence, getting priced out.
How did you find the other markets to invest in? I know some of those are not that far from Indy. Was that a part of it? Was it data? Was it demographics? What were you looking for in those markets?
So very comparable to Indianapolis in the economics, meaning that the population growth, the job growth as well, and then also the corporations that are within the city, but nothing too crazy when it comes to the growth. Slow and steady, which is what how Indianapolis has been, and then also preferably markets that are within about a 2.5 hour drive, because I have taken the strategy, and actually, when I say I again, there's a team involved, is that have taken the approach and going direct to the owner. So the way on how I follow up, I can say I in this particular case, but is how I would follow up with an owner is that it would be easier for, let's say it's Monday, Robert, I would follow up with the owner and say, hey, I'm actually going to be in town this upcoming Thursday. Would enjoy putting my hand in your hand, and or either catching up, and just another way to follow up. And it would be easier to take that trip, and that would give me the upper hand over the a lot of competitors who couldn't move with that type of speed. So that's another element that helped too, is that those economics, and then also how close it was to the Indianapolis market, about 2.5 hours.
You just mentioned briefly how you're finding deals, how you're getting in contact with owners, but break down for us your acquisition strategy. How are you finding deals? What strategies are you using? Are you doing any on-market stuff? Is it all relationship based? Are you doing direct listing to direct owner? Are you doing mailings? What strategies are you utilizing?
Yeah, so we're going to have to unpack that quite a bit, Robert. But is how the is pulling lists. So how it first started was taking the driving for dollars approach. That very first apartment, which was a 46 unit, is just driving around, finding properties that need work. This one in particular is you would the parking lot looked like an alligator's back, so it was just very bland and just needed work. So with that one is that was the approach that was taken from a lead generation standpoint, but the primary point of outreach is via calls, so cold calling. And then shortly after finding that initial deal is had to find another scalable approach. So then started pulling lists from, let's say, a database such as REI141 or even CoStar, and pull these lists and then do the outreach through that way and have VAs that are making the calls. And then soon as an owner raises their hand, yes, I would be interested in selling, not just give me an offer I can't refuse or everything's for sale for the right price. There has to be actual motivations. And then that's when the appointment's set for me.
I remember last time we talked, even though it's been a while, you walked us through kind of your script and your conversation that you have with these sellers when you're doing cold calling. Take us through that example. And I know you mentioned that your team is kind of making those calls for you. You're not necessarily doing it so much yourself anymore, but still, talk us through that a little bit. What is their script? What are they saying? How are they having those conversations?
Yeah, so it's very simple and transparent and straight to the point. There's no NLP. This person says this. I'm going to do a backflip there based upon what they said to what is it match what they what they said. There's none of that. It's just simply, hey, my boss. Well, it opens. Hey, Robert Sterling here. Did I catch you at a bad time? So we always open up with that. No, hey, how was your day? That just screams sales call. So we start out with that. Many of the times they'll say, well, what is this call regarding? And it's say, hey, completely understand. I'm sure you get these calls all the time, Robert. My boss wanted me to personally reach out to you. We just bought Bentwood Apartments across the street from yours and wanted to personally reach out to see if you consider selling. So very straight to the point, and it's either yay or nay from that. And many of the times they'll say, hey, not interested. Hey, I knew you were going to say that. Give me 30 seconds. If you don't like what you hear, I'll hang up on myself. Sound fair? Because many times you want to keep yourself in the call because they may just say not interested just to get you off the phone. It's the same as if you walk into a shoe store, which not many people do nowadays because now you could just order the shoes. But let's say you do walk into a shoe store and the person comes up to you and you just say, just looking. It's just a reflex. So that's one thing is on same as the call is you want to overcome that initial objection and find out if it's actually real. And then that's when you go into the fact finding to actually determine if there is a desire to sell or some motivation.
We've talked a bit about the markets you're going into, how you're finding those deals, some of your cold calling strategies. We haven't talked about what are you actually buying? Take us through your buying criteria. What does that look like? What are your criteria when you're going to look for something to acquire?
Yeah, so formerly these were actually have shifted the criteria since then, but more so around the 1970s built in construction. These are in B minus to B locations, and also just right outside the city. So not in the city, not in the suburbs, but just right out sort of that. I believe some people actually call it the urban core. So just outside of the actual city, and these are properties that need work. So that's formally how it was. And just give you a prime example, this is a 156 unit that bought about a year and a half ago. Is that it was $6.2 million as the purchase price, an absolute steal from a purchase price standpoint, and then put $2 million into that. So it was a heavy value add and actually now shifting more to the 1980s, less of the heavy lifting. Because what I'm finding or have found is that the risk versus reward, it's best oftentimes actually buy the newer asset that has less of the heavy lifting, because the more that has more risk is just not as enough of a spread.
I think you were looking for the word deferred maintenance, maybe.
I would say the delta in saying that you can buy something that, let's say, distressed at a 5.5 cap and then a B property or that's 1980s for about the same. So it's not worth the risk in going with something that has more risk, and deferred maintenance is a prime example, versus just now going with something that's 1980 that has less, because the costs are actually becoming very thin on the seat. because people are willing to pay more.
Are you raising capital for these deals?
Correct. Yes. All in house.
How are you doing that? Take us through the entire cycle from very beginning to the end of a potential investor in one of your deals. So take us from they just heard about you. You got to take them from the very, very beginning all the way to the end of when they actually give you money to invest in one of your deals.
Yeah. So how it starts from the beginning is content marketing. That is the way. Being on podcasts, being on bigger pockets is another example, as contributing content. So that way people come to you and they're more warmer that way versus you reaching out to them. So there's that. They come into the funnel that way. And then once a deal is under contract, then that's when you would email the investors and say, hey, we got this deal. It's under contract. We've got 30 days due diligence. We'll keep you in the loop of how things are progressing. And during that whole 30 days phase, and even prior to that, is we'll get soft commitments from investors. So take the approach there is raising the fund to where you already have the capital available. The process that I take is that once the deal is under contract, then start raising money.
Have you ever run into a situation where you got a property under contract and you weren't able to raise the capital?
So yes and no. So yes, on this was a deal that was the second, which was the 50 unit, but is didn't raise all of the money to actually have in the bank account. And that's one thing you want to have, is that you want to have the money raised that you need to actually close on the property in your bank account. Can't show up to the title company and say, hey, we've got about $1 million that's on the way. They don't care. You need that in your actual bank. And so on one deal, is didn't have, it was about 200 to about $300,000 left was needed to actually close on the property. So didn't have that. So in essence, had to get gap funding from a lender. So a short-term bridge until we actually to close on the property. And then we were still continuously raising to then cash that person out.
Has it become more difficult in recent, months, weeks to raise capital given the environment that we're in?
I would say is over the years is haven't been acquiring. So I wouldn't know necessarily on that. I do know my business partner who is taking a transition in raising capital for deals. There hasn't been any issues on that.
When was the last time you acquired a property?
This was a year and a half. So that 156 unit. So myself is over the years have been selling to get dry powder, because I believe we're going to start to, which I've seen a shift in the market to be more of a buyer's market, and want to have the cash ready and available to start to scoop these deals up.
How often are you using creative financing when acquiring deals, and which creative financing strategies are you using?
On the creative financing side, the very first deal, which was the 46 unit, was the creative. And we could go into the definition of what is creative financing. But I would say is for that one in particular is that the total purchase price was $900,000, of which it was seller financing. So I had to put down $200,000. The seller carried back $700,000, and then raised an additional $485,000 from outside investors to then take care of those improvements. However, after that, have just taken the simple approaches. If the property is $10 million is the purchase price, 7 million of that will come from a lender, and then raise the remaining 30% from investors. So that's the structure that have been utilizing going forward.
It sounds like you have some potentially strong opinions maybe on the current environment, given that you're selling off some properties, not doing any acquisitions currently. So what do you make of the current environment, and what do you think it means for real estate investors?
It's very uncertain times, I would say. And I'll tell you, Robert, the third deal that I acquired, it was an 80 unit apartment, Buck Ridge at Southport. Bought it for $3.35 million. A year and a half, 2 years later, sold it for $5 million. I have no clue how that person made that deal work. I'm looking at it. We're operating it at this. How can someone make that work? So it's just at this point not making sense where people are buying deals for. And I believe those same deals will start to come up because what they penciled out and their aggressive model likely is just not going to end up panning out, and then they're going to have to sell because they're not going to be able to operate the property at that level. Yeah, so that's what I see, those deals starting to come up, and then also the rising of the interest rates. also the thing is with commercial is that even with the inflation going up as another is that as inflation goes up, rents go up. So I don't see a huge shift when it comes to multifamily. Residential, for sure, that's already being affected. But I am starting to see sellers' expectations starting to come down to be more with where the market actually should be.
Are you keeping a list of any of those properties that you've sold that you felt were maybe a little bit on the steep side and you're not really sure how those people are making the deals work so that you can follow up with them in maybe 6 to 9 months, 12 months to see if they're ready to sell, just given that you know that their business plan might not have worked out?
Yeah, and because I made the mistake, and I don't know exactly how their numbers end up panning out or anything, but one of the deals that I acquired, which was a 50 unit, is ended up overpaying for the property, didn't raise enough money to take care of the renovations up front. Because if would have raised the money up front, then it would have affected the returns to the investors, and the returns were already it was already tight deal. And that this was a mistake I heard so many other people make, and was like, you know what? I'll be able to figure this out. And no, it didn't end up panning out that way. So I believe there's people now that are actually more so making that mistake as well. And I think that's the same. I wouldn't speak on that particular deal because I don't know their underwriting, but several years on that mistake that I made was just a year and a half later had to end up selling that. So that's what I believe. What you're saying is we'll definitely follow up with those.
How did that deal end up for you?
It was okay on the return to the investors, did not hit the expected projections, but it was a death spiral, as I would say. Is that the thought would be able to take the improvements that we would put to the upgrades to the units to then push those to the market rate rents out of the cash flow. You guys, everyone on here, please, 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 please jot this down. I know someone's going to make the mistake anyway, but that does not translate to reality, because it turns out that we just didn't have enough cash flow to be able to sustain that. So we were barely just breaking even on it and could barely pay distributions to our investor partners. So we actually had to sell it. But here's the thing, Robert, we sold it at the height of the market. Just think, is if we sold it in a downturn or actually couldn't be able to sell it and we would have had to ride it out, that would not have been a good experience. So that's why I want to share that with people. Is yes, it's good to learn from your own mistakes, but I tell you, it is even better to learn from others.
What would you say the biggest mistake was with that deal? Did you pay too much money or was it overestimating cash flow?
It was a combination, but I would say initially was in the scarcity mindset, and that, hey, we got to figure out a way to make this deal work. So that was first and foremost. And second, so one, overpaying for the property, but then second, by overpaying for the property, that caused us to creatively figure out ways to get into a bad deal. And that was not raising enough money to take care of the capex. So that was the second mistake that was made, and then that of course led to other things do. But primarily is overpaid for the property and was in the scarcity mindset.
Does the scarcity mindset mean that you felt that you were going to have a hard time finding another deal? So you felt like you had to make this deal work?
Exactly. And that is, I know we're talking about real estate, but that also works into other aspects of life. Is, let's say you're in the dating for whatever is you're in the dating, and you're like, oh man, I want this woman here, and I don't have any other ones that are close to this one or just in the pipeline, for lack of better words. And then you overlook all the red flags in order to make that work. So it's the same thing in this case.
How have you applied what you learned from that deal to future deals?
Are we talking about dating or are we talking about real estate? I'm just kidding. Yeah.
Either way you want
I'm
to
just
take that.
kidding. No, I'm just kidding. So how that works is just having more of the abundance mindset. Is numbers don't lie, and the numbers tell you an actual story. Is that is and you have to look at it objectively and logically and not get your emotions involved with it. So that's the biggest thing I've learned, is that if the numbers tell you one story, is just to stick to those numbers and don't look to creatively figure out a way to get into a bad deal. And I had a call with this other investor that is the he was looking to buy a deal, and he was asking me for all these creative ways to finance the deal. And I said, I know what you're asking me is, I remember asking others the same question on a bad deal, meaning that I was creatively trying to figure out a way to get into a bad deal and overpay for it. There's no creative way to get, or why you should back into a bad deal.
How did your investors handle that? How did they kind of just accept what that deal became?
So luckily, I had a track record before that and having good to great returns on that. And this was just one of those deals that, through the whole entire process, was very transparent with each and every one of the investors. So it was unfortunate. It wasn't that they lost money or anything. It was they got their initial investment back. We just didn't hit our original projections. So as we were transparent through the process, and then also set that expectation that, hey, we're not going to get what we thought we were going to get. This is what we're actually shooting for on this. They were okay with that. And they actually, some invested, some didn't invest in our upcoming deals. Others did, because we were transparent throughout the whole process. And those things is on here. I'm okay with sharing my mistakes, because mistakes are going to happen. And I want to be transparent with everyone on here. That way you can learn from my mistakes.
I'm sure it's going to vary from deal to deal, but what do you classify as a good deal? What are your benchmarks or hurdle rates for whatever metrics you look at? Are you looking at cash on cash, IRR, payback period? What are you looking at, and what are those benchmarks?
Yeah, so primarily the cash on cash and IRR. So for the cash on cash to be uh, double digits, so 9 to 11 percent, and then for the IRR to be closer to 20%.
And are those hard rules for you in that you won't, if it's 8%, you're not even interested, or is it have some wiggle room there?
Yeah, there's some wiggle room, but it comes down to the risk versus reward. So if it's, which wouldn't even look at a property that's in a really bad location, but is want to be close to those metrics that I mentioned to you. So there is definitely some wiggle room.
What are you looking at now that's going to tell you now is the time to start buying? Like when do you know it's going to be right to start buying again?
I would say the sentiment, I think is how you pronounce it, among the investors that I currently speak with, because there's investors that are even further along in their journeys than I am, is that when the overall sentiment is not a seller's market. So once I start to see more of a shift, it is shifting a little bit, but even the brokers I'm still communicating with is that buyers are still able to come up to above market prices. So once the brokers actually start calling me and following up with me, hey, you want to look at this deal? Hey, it's been sitting a little bit longer. There's a final call to offers. And then after the final calls to offers, there's another highest and best and another round from that. Once I see a slowdown on that side, or maybe even a black swan event comes, Robert, then that's when I believe it starts to be the time to pull the trigger.
Are you not concerned that you're potentially trying to time the market? And, Warren Buffett is very famously said the best time to invest is when there's blood in the streets, and, be fearful when others are greedy and be greedy when the others are fearful. And I think people have been greedy over the last few years, and people are a bit fearful now. So maybe it's our turn to be greedy. So I'm curious how you kind of balance that dynamic.
That is actually a great point, Robert. And yeah, it, from what I indicated, is some form of timing the market, but preferably, which you can use in, which is used more so in, let's say, in investing in stocks or other asset classes, is using the dollar cost average. So that would be similar. In this case, is it doesn't have to absolutely be rock bottom, because trying to time the rock bottom is virtually impossible. So as things start to turn down, and when underwriting deals, actually able to pencil out close to those cash on cash returns that I mentioned to you, or ROR, IRR, doesn't have to be absolutely closer to 20%, but it just has to come down to the risk versus reward side. It could be 17%. But is look at that, and then once things start to shift to be within reason, then that's when we'll start to pull the trigger.
Sterling, as we wrap up the show here, I want to give you a chance to tell the audience where they can go to connect with you. What are the best resources, websites, social media? Where can everybody find you that wants to learn a bit more about you?
Yeah, so you can find me on sterlingwhiteofficial.com. That is sterlingwhiteofficial.com. And then also I'm pretty active when on the YouTube side. So you just type in Sterling White, look for a bald, handsome guy with a smile, and I'll come right on up.
I will be sure to put a link to your resources, everything you just mentioned in the show notes below. I'll also link to our previous episode that we did together for anybody that's interested in going back and checking that out as well. Sterling, it's been 2.5 years, but thank you so much for joining me again. It was great to catch up.
Likewise. And Robert, any pivotal or changes that's you experienced on your side in the past 2.5 years?
No, I wouldn't say nothing pivotal, really. Just kind of small,
We got the
just
beard.
taking small chunks. Yeah, I got a beard. So I guess it's maybe the most pivotal thing is I was able to grow a beard, which is interesting because no other male in my family can grow a beard. My dad, my brother, everybody else is very bald face. So I was not surprised. I was very surprised and not expecting to be able to grow a beard. So yeah, I guess I would say that's pivotal. But on the more business and front, really is just kind of chipping away, and in real time, nothing seems overly pivotal, really. But when I look back, I think 5-10 years, I think every little notch is going to look back, and
It's
I'll
going
see
to
that I
compound.
moved a lot. Yeah, exactly.
All right. Well, I definitely appreciate you having me again on the podcast, Robert. I really enjoy chopping it up with you.
Well, thank you, Sterling. We'll catch up again soon. Hopefully sooner than 2.5 years.
Yes, let's do it.
Should I rent or should I buy? That's a good question.
But there's always option 3.
Exactly.
Yep.
I was just like, there's a third option. It's like almost always the best option.